Hi, thank you for being here. Again, I'm glad and happy to be back. It's been a couple of years. A few things happened. You have lost football, you have regained football. All kinds of other things happened. I got married. All kinds of good things happened. I know. All good things happened in the last few years. And I'm glad you all came back after I do recognize a whole lot of faces after you had to sit through 9 of these in 11 and 12, and you're still here, so that's good. So what we want to do tonight, or I want to do tonight, is just give a little talk about the banking system and a little bit about what kind of banks are there, some of the myth maybe about the banking system. Maybe I can provide some insights at what's true and what's not true. A little bit about the role of the Federal Deposit Insurance Corporation and what it is that they do, and the role of the Federal Reserve. And at the very end, I'm going to talk a little bit about the quantitative easing, just in case that there's so much been talked about that, because I think a whole lot of people don't really understanding what that really is, what they've been doing in the last 3 years. So that's the agenda. That's the agenda for tonight. Now, what is a bank? That's always there's a whole lot of different images of what a bank is. Now, legally, it is actually very simple. If you look in the Bank Holding Act of 1952, I believe, there's a definition of a bank in there. And it's basically a bank is an institution that accepts deposits and makes loans. That is a bank. Any other financial institution that you come across that does not do both of these things is not a bank. Now, that doesn't mean that there are not other places that give loans, but there might not be taking deposits. There might be places that take deposits, but they don't make loans. Neither one of those are banks. And it's very important, because if you're a bank, you're regulated in a certain way. If you are any kind of other financial institution, you're regulated in a different way. Now, what we're focusing on tonight is what we call commercial banks. Now, which are institutions that accept deposit and make loans. And we have the large banks, and we have the small banks. We have the money center banks, those are the large banks, the Bank of Americas, the Regions, the PNC, the BB&Ts of the world. Those are our large money center banks. Those have large footprints around the country. Some of them, like Bank of America, for example, has a coast-to-coast presence. Wells Fargo has a coast-to-coast presence. So they have branches on both sides of the country. A bank like Regions does not have a coast-to-coast presence. A bank like Regions has a southeast presence. They go from Texas to Florida and everything in between. That's for Regions. It's still a large bank, really large bank. And then you have banks like, again, the Banks of America and the Citicorps, Wells Fargo. They not only have a national presence, but they also have a global presence. But those are really just a handful of financial institutions. We're hearing all these things about we have all these large banks and they're controlling everything. We only really have 4 large banks. If you and we'll get to that in a minute on that little table that I put on the PowerPoints about different banks. But we have the large banks, and then we have the small banks. We have the community banks. Now, these are small banks that are pretty much just, as the name indicates, within the community or within the state. They don't really spread out much, and they have a very specific purpose. Now, again, they are much smaller. They are significantly smaller. They have a very different purpose. Now, they are there to serve the community. They're there to make loans to the community, to make loans to small businesses. They don't make loans to large corporations. That's not their business. They can't actually do that because they don't have the means to do that. They are focused on the community, which on the one hand is a good thing because they provide a face-to-face service that a lot of large banks do not. A lot of large bank operations are centralized. Now, if Regions makes a small business loan anywhere in its footprint, it's going to be decided upon right here in Birmingham. There's an office where all these loan applications come in, and they're going to be decided upon right here, centralized. Whereas if you have a small community bank, the business owner might go to the bank, talks to the loan officer, and the decision is most likely going to be made by that loan officer and maybe a loan committee within that bank. And it's a much more personal process. There's much less distance between the lender and the borrower. And that's something that we've seen in the last 2 years is an increase in what we call lender distance, which is the difference between where people borrow money and where that lender actually is located. It used to be you need a loan, you go to the bank on the corner of the street. You know, that's where you got your loans. That's not how this works anymore. Today people go on Lending Tree, you know, and find a bank in Oklahoma to give them a loan. You know, you will never see that bank, they will never see you. The only thing that you do is you turn in some paperwork to them, and hopefully they're going to send you money, and then they're going to send you a bill every month. You know, that's the only transaction that you have with that. You're never actually going to see a person. Never actually going to see a person. You know, all you're going to see is, you know, computers. And that's the large banks. Now again, the small banks serve a community, which is great. At the same time, it makes them a little riskier. Because if I'm a small community bank, my loans are all going to be made to that small community. Meaning that if something happens negatively in that community, there's a regional economic shock, that bank is going to be directly affected by that and has no other loans that diversify that risk. Like we saw, for example, in the 80s, now going all the way back to the 80s in Texas. Texas had very strict banking laws in terms of where banks were allowed to operate. They were not allowed to branch outside of the city or the county limit. And now that's how far they were allowed to go. Now, they were lending a lot of money to to the oil industry. Now, when the oil industry ran into some trouble in the 80s because the oil prices went down, and they all went belly up, well, what happens? This oil company in that town goes up. Maybe there's 2 or 3 of them in that town. They will not be able to make their loan payments. So the bank is going to lose those loans. These are all the loans they had. Maybe they also were lending money to the local businesses because the main employers in the town went down. So the local businesses had a problem too. So they couldn't serve their loans anymore. And as a result, the bank would go belly up too. That's the danger, is when you have a very small bank that is very localized, because you don't have the means to diversify your loan portfolio. If you have a larger bank, if you have a super regional presence or even a countrywide presence, you can diversify your loan portfolio in all kinds of different industries, in all kinds of different regions. So one economic shock in one particular region does not bring the entire bank down. That is one of the benefits of a larger bank. So these are just different types of banks. I'm not going to go through all of these. You can look through these in case you always wondered what is this, what is that. Again, we're talking about, and some of these are overlapping. They're just different names for different things. We'll want to focus on commercial banks today. This is those are the banks that we are all dealing with on a daily basis. Now here's what I wanted to show you. Now these are the 18 largest banks. I went out to 18 so I could squeeze regions in there. That's the only one of those banks that is headquartered in Birmingham. So I put that in there. Now you might see something. You look at the first 4. If you look at the first 4, and this is it's mind-boggling. I mean, J.P. Morgan Chase has $2 trillion in assets. That's more than the GDP of about 20 countries, smaller countries combined. I mean, it is amazing how much assets they have. And Bank of America, Wells Fargo, and Citigroup are not far behind. Now you can also see for example, Citigroup is by far the most global bank. Only half of their assets are actually domestic. The other half are the assets that they have in their global operations. But the most telling thing here is when you hear about all these large banks, we only got 4 of them. Look at the step from 4 to 5. Now this is, $400 billion is still a lot of assets, but for a bank it's really not that much. This is a third of Citicorp. There is this huge gap between those four, and when we talk about the banking crisis and how we had to bail out the banks and all these troubles, it was this one and this one that caused all the trouble. Bank of America and Citicorp caused all the trouble. JP Morgan didn't cause a lot of trouble, Wells Fargo didn't cause any trouble at all. Citibank and Bank of America were the two that caused a lot of trouble. Now obviously they're incredibly large, those two. And they are the ones that made a lot of headlines. Now JP Morgan made some headlines too with some kind of boneheaded things that they did, but they did not cause a systemic risk to the financial markets. Bank of America and Citicorp did. And if they weren't that big, and there's such a thing as we call it, too big to fail, and that's are those four, those are too big to fail. And they are too big to fail because there's nobody who can take them over. They are just too large to be taken over. Now all these other banks, if, let's say, SunTrust were to fail, you'll find someone who takes over SunTrust. $185 billion in assets is not something that's going to hold anybody back. Wells Fargo took over Wachovia. Wachovia would have been number 5, or was number 5 at that time. Wachovia was one of the largest banks in the country. But, they were in this category. They were not in the trillion-dollar category. And so we have a whole lot of large banks, and some of them are, some of them you might know, some of them we have here in town. We do have, obviously, this is US Bank, we don't have those. We have PNC, we have some PNC presence here. We have BB&T, which is down at number 12. And we obviously have Regions. Now, Goldman Sachs and Morgan Stanley are technically not commercial banks. Now, Goldman Sachs does have a bank license. They got a license in 2008. So technically, they have a national license to be a bank, but nobody has yet seen a Goldman Sachs debit card. So it has not happened. So they do not actually do any of this business that a commercial bank does, but they do have a bank charter. And they wanted one and needed one because you need a bank charter in order to be eligible to borrow from the Federal Reserve. So they got one. Morgan Stanley, again, is also not a commercial bank, that is an investment bank, those two. But the rest of them are all commercial banks. Again, some of them we have here, some of them you might have heard of, like number 10, that's actually Toronto Dominion. You might have heard of TD Ameritrade, that's their trading arm. TD Bank is out of Canada, that's the US operations. That has nothing to do with TD Ameritrade, that is just a banking operation. HSBC is Hong Kong Shanghai Bank Corporation, that's their North American business, and so on and so forth. So but what I wanted to point out here is this huge step between 4 and 5. That we have 4 banks that do cause some problems and have caused some problems, particularly 2 of those 4. But the rest of them are fairly small, relatively speaking. If you look at it, and it's gotten different. In 1992, Citicorp was the largest bank in the US. Citicorp was the largest US bank. Worldwide, only number 35. So in terms of total assets, the largest US bank in the largest economy in the world had only the 35th largest bank. And that is because there were restrictions on how banks could grow, which were not taken away until 1994. We're going to talk about regulation in a minute, because regulation, everybody always hears about it, and it has a lot of negative connotations to it. But when it comes to banks, there is a very, very simple story to be told. But let's look at something that maybe nobody has thought about, and then for the function of a bank. Now, banks do actually think, when it comes to creating money, the Federal Reserve creates money. No, banks create money too. Now, they do not print money, and neither does the Federal Reserve most of the time. We're going to talk about that later. None of the money that the Federal Reserve got into the economy over the last 8 years was actually printed. None of it. The actual amount of physical currency has not changed much in the economy. But if you look at this, let's say somebody makes a $100,000 deposit in the bank. Now, banks have reserve requirements, which means that some of the money that's deposited in the bank has to stay in the bank. They cannot lend it out. But generally what banks do, and that's one of their major functions, they take your savings and they serve as an intermediary and transfer those savings into loans to businesses and individuals. That's what banks do. That's their transformation function, the most important function that they have in this economy. So they take those $100,000 and they're going to lend out 80,000 of those. So those 80,000 are going to be deposited someplace else, maybe at a different bank. So then that bank is going to take those $80,000. Now, this is a 20% reserve requirement, so $16,000 of this they're going to have to save or keep, and the other $64,000 they can lend out again, and so on and so forth. And if you go through this whole process, you know, if you just go all the way down here, these $100,000 in deposits have grown to $336,160, $67,000 in reserves, and $268,000 given out in loans. Out of those initial $100,000 that somebody deposited in the bank, just after 4 transactions. Now, every time this happens, it's going to go on and on and on until there's no money left to lend out. And we call it a money accelerator, money multiplier. You know, that's how banks create money. Banks have the power to create money because they take your money and they lend it out, and whoever gets that money, they're going to put it in the bank, and the bank is going to take that money, which is your money, just once removed, and going to give it to somebody else, and then they're going to give that out, again, your money, not twice removed, and then lend it out again, and so on and so forth. And this is what happens. Your $100,000 are going to be lent out already 3.36 times. You know, I mean, they are already increased by 3.36 times over this process. That's how banks create money. That's why they have such an important function in the economy. They're the only ones that do that, because they're the only ones that take the deposit and make the loans. Somebody may take deposits but doesn't make loans. Somebody makes loans but doesn't take deposits. They are doing both, and they're creating money like that. Again, they're not printing it, they're just creating it. Now, before 1913, they were also printing it. You know, before we had a Federal Reserve, before we had a central bank, banks would actually issue the money. You know, and so the dollar would have the name of whatever bank on it that printed it. So, but that got a little messy. That's why they created a central bank, because it was transferable. You know, people wanted to take their stuff, their money out, and they couldn't. Okay, here's the roles of banking. The intermediation role, as I said, they take savings from one party and they're going to turn it into loans to somebody else. That's what they transform, and they transform amounts and they transform maturities. So in other words, you might have $1,000 that you put in the bank in a 3-month CD. The bank might take 500 of those dollars and make a 5-year loan with it. So they transformed your $1,000 for 3 months into $500 lent out for 5 years. That's the transformation. That's why the intermediary. You had $1,000 that you wanted to save in a 3-month CD, and they're going to find somebody who needs $500 for 5 years, and they'll bring you two together. Now you still want your money back after 3 months, so that's where the bank comes in, and they're going to continue to find someone who can continue to meet those desires of the customers. That's what the bank does. They have a payment role. You do write checks. You have debit cards. You know, you have bill pay, and all of these kind of functions that go through the bank. That's a very important role. The economy could not function if you could not use your debit card, could not use your credit card, if they were not clearing these transactions. You know, this has to be, somebody has to provide those payments functions. And the banks do that. They provide you with cash. You can go to an ATM machine. You know, that is a very important role that they have. The rest of them are not as important. for us in our everyday dealings with the bank. But there's a whole lot of other things, functions that banks do fill out, and that make them very important. They're also called delegated monitors because they are looking. You're indirectly invest into the bank, into the company that the bank puts money in, that the bank lends money to. The bank is in charge of monitoring that loan so that your money is not at risk. And that's something that you see in the stock market, which is going on our topic next time. When a bank makes an announcement that they're going to give a loan to a large corporation, the stock price always goes up. It always goes up as an announcement is made. There's empirical studies about that. And that is because the market thinks the bank knows more about that company than anybody else does. Because when you want a loan from the bank, you have to give them all the information you have. Proprietary information. They require proprietary information. As an investor in the stock market, you don't get that. You only get publicly available information. But the bank knows things about the company that the stock investors do not know. So the logic is, if the bank feels secure enough to give them a loan, that means they at least believe that the company is not going to go under anytime soon. That the company is going to do well enough to pay back that loan. And if it's a loan renewal announcement, meaning that the loan that they had expired and the bank said we're going to renew that loan, you get even a stronger reaction from the stock market to that. Because now the bank had an even longer period of time to look at that company, and the market feels even more confident about that. Now, on the flip side, we do have to remember banks do make a whole lot of bad loan decisions. They do, and that's one of the reasons why we had the financial crisis as we had it in 2008. One of the things that is true about the financial crisis in 2008, and this comes here with the bank regulation, the banks that went under in 2008, 2009, 2010, if you look at their balance sheets, they do not look any different from the banks that went down in the late 80s and early 90s. They have the exact same balance sheets. Meaning, when you hear this talk about, well, this was like crazy and this is never going to happen, it happened before. And I guarantee you, 20 years from now, it's going to happen again, because it always does. It always does. In the late 80s, early 90s, when we had all these banks go down, what was the culprit? Real estate development loans. That was the culprit. Large concentration of real estate development loans. Those were the banks that went under. 2008, 9, 10, the banks that went under, large concentration in real estate development loans. The difference was, in the 80s, it was commercial real estate, and 2008, 9, 10, it was residential real estate. But it was real estate development loans. That's what drove the banks out of business. It was not individual mortgages, because those that all sold off. That did not drive down the banks. It was real estate development loans that drove down the banks. And it was the same in 2008 as it was in 88. And just 20 years later, same thing, just different time period. That's all that happened. Now we are regulating banks because, they have our money. That's the number one thing. We need to feel safe about the fact, because if we do not feel safe, or feel that our money is safe with them, we're not going to give it to them. No, that's the number one reason why banks regulate. That's why Region is regulated and Walmart is not. Because if Walmart goes under, yes, we might be all sad about it, but it does not affect us personally. Now we just go somewhere else. But if Regions goes bankrupt, it might affect us personally because our money is there. And even though our money is safe, we'll talk about the FDIC later, that doesn't mean that we're still not scared about it. And that's why banks are regulated. Now, they are obviously also creating money, as I said before. Because of that, they need to be regulated, so that they don't go crazy. And there's a whole lot of also federal and state authorities that regulate banks. Now, the interesting thing about regulation in this country, first there is 3 federal agencies that regulate banks. But the interesting thing is, when you look at regulation, the latest one is the Frank-Dodd Act, and I don't want to go into individual regulations, there's a whole lot of them. But what we saw when we had the last banking crisis prior to 2008, in the late 80s, early 90s, that was preceded by a period of deregulation. In the early 80s, 81, 82, there was a whole lot of deregulation going on. As a result of deregulation, we ran into the savings and loans crisis, because now savings and loans were allowed to do all kinds of things that they were totally not qualified to do. The people that were operating those banks were not qualified to do. But they were allowed to do these things now, and they ran themselves into the ground. So then in 92, we regulated banks again. There was some strong regulations put in place, what's called FDICIA, or the Federal Deposit Insurance Corporation Improvement Act, that allowed the FDIC to act on all banks that are in trouble, move right in and take them out. They weren't allowed to do that prior to that. So we regulated, we tightened the screws. Then things were okay, so we deregulated again. Late 90s, early 2000s, all kinds of things that banks are allowed to do now. And what happened? 2008 happened. Every time we loosened the screws on the banking system, we ran into a banking crisis. That happened every single time. And it's going to continue that way. Because now we have stronger regulation. There's already been major resistance against it. There's been pushing against it, and eventually they're going to take it back a little bit. And then it's just going to continue on as it was. Yes?
I thought it was because a lot of the savings and loans held mortgages and at low terms, and then all of a sudden the interest rate went up to 12–13%, and they were affected because of that reason.
Well, what happens? You're right. That's why the federal, why the regulators allow the savings and loan and the bank to they were running out of deposits. You're right. They had problems getting money, getting customers to actually put money in their bank because they were not allowed to pay interest on the checking accounts. That is correct. So what they did is they waived the regulation Q, what it was, and they allowed interest payments on checking accounts. But what happened on the other side of the balance sheet, they said, well, because the residential mortgages are not generating enough money for you, why don't we just allow you to make commercial mortgages and get all kinds of other loans and get into real estate development and invest in junk bonds and all that. And that's all of a sudden they were allowed to do all of the things that they weren't allowed to do before. And that's what happened. Now they started making real estate development loans. They were investing in non-investment grade securities. And as a result of that, when these loans all went belly up, that's when the banks went under. To this day, by the way, the US taxpayers are still paying for the savings and loans today. They're still, because they actually created a fund for the bad assets back then. That's why they didn't do it this time, because it didn't work so well the last time they did it. They created an institution that got all the bad loans from the savings and loans. And we're still paying for those today, taxpayers are. But that's what when it opened up to banks that they were allowed to do a whole lot of things that they weren't allowed to do before, that's when they got, oh, I can make this real estate development loan, I can charge a much higher interest. I'm sure that the risk is not that big a deal. And what helps is moral hazard, deposit insurance. I can make those loans. I don't have to worry about my customers necessarily come and run after me with a pitchfork because I went through their deposits, because the deposits are insured. So I can take a little bit more risk than I otherwise would have taken. Now, if I had to worry about that my customers would all be waiting for me when I come out the bank because I was gambling with their money, I would be a little more careful. But but if I know that back then up to $100,000 everything is actually insured, and particular savings and loans, they didn't have holdings, savings that would exceed $100,000 in their banks. So then I said, yeah, it's all going to be good. We don't have to worry about that, but we can make money on this side. This is now things that we never were allowed to do. This is really exciting. Just like they were not allowed, we allowed them to invest in mortgage-backed securities, in non-agency mortgage-backed securities in the 2000s. We allowed them to invest more in all kinds of other structured finance instruments that then actually ended up going belly up and hurt those banks. Some of them that were actually that invested in those. Citicorp and Bank of America were hurt because of their investment portfolio. That's what hurt them the most, because they invested in all kinds of things that lost a whole lot of value in 2008 and 2009 and got them whole lot of trouble. They weren't always allowed to do that, but at that point they were. And so generally when re-regulation occurred, to the point where we said we don't really need any restrictions, we saw some trouble. Now there's got to be somewhere a middle way where you can regulate but not over-regulate. It's talking about something that's called regulatory dialectic, where basically regulators are going to put in some regulation, and then the banks find some way around it, and then you're going to have to respond to it as a regulator and find some other way to regulate it. That's how we saw innovations in the banking industry. I mean, when you're looking at CDs, for example, CDs were a way to get around the fact that I wasn't allowed to pay interest on checking accounts. So I created something different. I created something that was not covered under that law, and I was just selling that to people. That's how we got credit default swaps. You know, credit default swap is an insurance policy, nothing else. It's a credit insurance. But if you call it a credit insurance, you're going to have to hold capital against it as an insurance company, which makes it expensive. If you call it a credit default swap, it falls off the balance sheet because no swap, it's not on the balance sheet, meaning you don't have to hold capital against it. You do not have to hold expensive equity against it. So therefore, you're much more likely to do these, and in much larger quantities. Again, you found a loophole, and you walk right in. And then you're going to have to close the loophole. And generally, that doesn't happen until something bad happens. That's when these loopholes are being closed. Now, the Federal Reserve, the Office of the Control of the Currency, and the Federal Deposit Insurance Corporation are the three main federal regulators of the banking system. The Federal Reserve supervises, examines all member banks. All national chartered banks are members of the Federal Reserve System. State chartered banks can be, but they don't have to be. There's really not much of a benefit to being a member of the Federal Reserve System, because all the services that the Federal Reserve offers, they're offered to members and non-members. The only thing that you have to say so, if you're a member, you get to vote for the board of directors of the Federal Reserve in each one of the 12 districts. So that's pretty much the only difference that it makes if you're a member. And maybe you can tell people, well, I'm a member of the Federal Reserve, it might make your customer feel more secure. They impose the reserve requirements. Again, as I said, every bank has to put away a certain percentage of their deposits as reserves. The Federal Reserve tells them how much that is. And they basically change that once a year. Every December, they're going to change that. It's not earth-shattering what they do. They're just adjusting to general economic conditions. All mergers and acquisitions in the banking industry have to be approved by the Federal Reserve. If a bank wants to acquire another bank, the Federal Reserve has to approve it. If the Federal Reserve doesn't like it, it's not going to happen. That is the number one. That's one of the biggest things that the Federal Reserve does. Any kind of merger and acquisition of banks has to be approved by the Federal Reserve. The Office of the Control of the Currency, which is a part of the Department of the Treasury, supervises, examines all national banks, just like the Federal Reserve does. Every bank that has a national charter has to is under the control of the Office of the Control of the Currency, or OCC. So they issue charters for national banks. And by the way, when you see a bank, for example, that says First National Bank of something, that is a nationally chartered bank. You cannot call yourself First National Bank of something if you do not have a national charter, meaning that you're allowed to do business all over the country. If you only have a state charter, meaning you're only regulated by your state banking authority, you cannot call yourself First National or Second National or anything national. You're not allowed to do that. But there's a whole lot of banks that only have state charters. Now, Federal Deposit Insurance Corporation insures our deposits up to $250,000. All the members have to submit reports on their financial conditions every quarter. You can pull them up. You can go to the FDIC website, fdic.gov, and there you can pull up the quarterly reports and a report of condition for every single bank. Because here's the thing about the FDIC. By federal law, only nationally started banks have to be FDIC insured. They're required to be FDIC insured. However, every single state in the country, all 50 of them, require the state-chartered banks to be members of the FDIC, which means that every single commercial bank in this country, every bank that takes deposit and make loans, regardless of the charter, is a member of the FDIC. So when you go to the bank and you see that sign, member of FDIC, it's really a useless sign to put out because every bank, if you're dealing with retail deposits, if you have retail business, meaning you have individuals walk into your bank, you have to be FDIC insured. Now again, federal law is one thing, but state law. Now if one of the states decided tomorrow to change that, that's a different story. But as we stand right now, every single bank with a state or national charter is FDIC insured. Now, let's talk about the FDIC. Now this is, a scene as it was seen in the early 1930s. This is a bank run. This is where people were afraid that their deposits would be lost. At that point, in 1930, prior to 1933, we did not have a deposit insurance. It was created by the Banking Act of 1933. The Banking Act of 1933 created the Federal Deposit Insurance Corporation. As a result of the one thing, because here's what happened. There's a very specific reason why this happened. In the 1930s, again, there was a lot of fear. There were lots of bank runs. You all seen It's a Wonderful Life. That scene in there, that's a bank run. That is all that is. And they all come in the bank and they want the deposits back. That's a bank run. Now, the worst thing you can ever do to a bank is take the deposits away. If you want to bring a bank down, that's all you got to do. If you all want to organize and decide we're going to bring down Regions tomorrow, just tell every depositor of Regions to walk into their bank branch tomorrow and pull their deposits. And that bank is gone. That bank is history by the end of the day. Because they don't have all the deposits, sitting around. Citicorp, for example, has over $1 trillion in deposits. They don't have $1 trillion sitting around to give out to people if they all came tomorrow. So if you want to take the deposits out, you can bring the bank down. Now, the other problem is, if you're afraid that your deposits can be lost, you're just not going to put any deposits in the bank. Now, if you don't put any deposits in the bank, then the bank doesn't have any money to lend out. So one of the problems that we had in the Great Depression, or what turned a Great Recession into a Great Depression, is that there was no money available for the banks to lend out because all the deposits were pulled. And therefore, nobody could get a loan to grow the economy. And that's why a bad thing got worse. That's why, Ben Bernanke, he was the chairman of the Federal Reserve in 2008, who is a world-renowned scholar on the Great Depression. That's where he made his mark. That's where all his research work came from. And he was an economist at Columbia. He saw that, he knew that from his research, and that's why the Federal Reserve reacted the way they did in 2008. Because you do need to have confidence in the banking system, and if you want to make sure that this economy does not completely spiral out of control, you've got to make sure that there's money there to be lent out. If that's not there, then the economy is going to completely spiral out of control. If you have a credit crunch, that's it. And that's what happened in the late 20s and early 30s. And that's why the FDIC was created. And that insures deposits up to $250,000 per depositor, per insured bank for each account ownership category. Now, this is what that means. Let's say you have a checking account at Regions. That's insured up to $250,000. Then you have a CD at Regions, insured up to $250,000. Then you might have an IRA account at Regions, another $250,000. Maybe you have a joint account with your spouse, that's another $250,000. So all four of those together, that's $1 million worth of deposits are insured. Now, if you put $1 million worth of deposits in just one checking account, then you have $750,000 that are not insured. So per account type, per person, per bank. Now, if you have $1 million that you need to put in checking accounts, then spread it over 4 banks. Open 4 checking accounts at 4 banks, and you have each one of those insured up to $250,000. So, and there's actually on their website is a calculator, and you can put in all the accounts that you have, and they tell you how much money you would get if they all were to fail. And as long as they stay below $250,000 per account type per institution, you don't have anything to worry about. The FDIC has never failed to pay. Anyone has never failed to pay. Now, the FDIC is funded by the insurance premiums that the banks have to pay. But it's also backed by the full faith and credit of the federal government. So in other words, if they were to run out of money, the federal government would make up the difference. Now, generally, the federal banks do not go under. Not like you think a bank is going to go bankrupt. That doesn't happen. Generally, and we've seen it here, there's a whole lot of banks that disappeared here in Birmingham in 2008, 9, and 10. A whole lot of them. And I don't know, maybe you were a customer with one of those that went away. All that happened to you, you got a letter in the mail saying your bank is now owned by such and such. They're going to send you a new debit card, they're going to send you new checks, nothing changes, there's just a different name on your debit card and on your account statement. Because what the FDIC does, and that's what the Federal Deposit Insurance Corporation Improvement Act of 1992 allowed them to do, they can move in immediately when a bank or credit institution fails. And generally what they do is they go in and they say, okay, we need to find somebody to take over this bank. And they're just going to sell it to the highest bidder. And what they do is they shift all the deposits over to the new institution. And they give them all the assets too. But because the assets are obviously problematic, that's why the bank went down in the first place, the FDIC guarantees those assets up to a certain percentage. And let's say I guarantee 80% of your loans. Meaning if this loan goes under, I'm going to give you 80 cents on the dollar for that asset. And that's a good enough risk for somebody, because they effectively get those banks for free. They effectively get those banks for free. And they get enormous amount of deposits, they get already in infrastructure that's in place, the brick and mortar and all of that. And that's a really, really good deal for those banks to get those. And that's what generally happens. Now, there is a wonderful piece on 60 Minutes. And if you want to, I put that link on here if you want to check it out. It's called Your Bank Has Failed, What Happens Next? It's a great piece about what the FDIC does and how the FDIC operates when a bank goes under. Because you'll never know. One other thing is that the FDIC, these takeovers happen in complete secrecy. But they come on Friday afternoon at 6 o'clock when the bank closes. That's when they walk in. That's when they walk in. And then they work through the night so they can open up that bank again on Saturday morning. And so that nobody has to steal anything. You will never know other than there is a new name on the bank. That's the only thing that changes for the customer. Your money is safe. I always tell people just because your bank goes under does not mean you don't have to pay back your loan. Unfortunately, you're still going to have to do that. Even if the bank were to disappear, you're still going to have to pay back your loan because they're going to just sell it to somebody else. But this is a great, if you get a chance to see this, this is actually back from 2009, I believe. It's a great piece on how the FDIC operates. Just to see, they're right there with the cameras, following them in one of those takeovers of a bank in Chicago. It's a really, really great piece, just to get an idea of what it is that the FDIC does. And that's the main thing. That's the main thing that the FDIC does. They're monitoring banks, and when they see trouble, when they see banks being in trouble, they just take them out. And that's why they weren't allowed to do that prior to 1992. And that's why in the 80s and early 90s we had a lot of what we call zombie banks. Banks that were really dead, but were still open. And because they had negative net worth, meaning they had more liabilities than they had assets. But they had no legal right to shut them down. And that's different now. It's been different for 20 years. It's been a very good system. It has really worked very well. And nobody ever has to be afraid. If you have less than $250,000 in that bank, you don't ever have to worry about it. You don't ever have to worry about it. And I saw it when Wachovia had some trouble, how people were going to Wachovia here in Birmingham trying to pull their money out. And I always say, the best sign to see if your bank is still good for it Take your debit card, take your ATM card, and go to an ATM machine that it's not one of your banks. Put that in and try to withdraw some money. If that ATM machine is going to still give you money, your bank is safe. Because trust me, no other bank is going to give you money if they don't think they're going to get it back. You know, so it is as simple as that. You are not going to get anything out of the ATM machine if they don't think that they're never going to see the money paid back to them. So you don't have to worry about that. There's really no, and it's really true. If you run to the bank and pull the money out, you make it a bad situation worse. Nobody, that doesn't help anyone to do that. There is processes in place that take care of all of this. That we don't have to worry about these things, that we don't have to say, oh, my deposits are in danger. And even when you see those CDs in the Sunday newspapers, you know, you see all these banks with the advertisements for CDs. And some CD rates are so significantly higher than others. That's generally a bank that is desperate for deposits. They need money. And that's their best way of getting it. Now, as long as you stay within $250,000, that CD is safe. So you're not going to lose. You can get that extra percentage in return. You don't have to worry about this. This is not so much a function of risk, that higher interest rate that you get, but more a function of desperation, the liquidity need that that bank has. They might have some CDs that are come due and they need to, they don't want to borrow from the Federal Reserve, or they don't want to borrow from another bank, and they'd rather want to get CDs, and they're willing to pay a little extra. But it's safe. You don't have to worry about this. It doesn't matter if it's a bank here or a bank in Seattle. If there's any trouble, up to $250,000, and you get your money within a couple of days. Again, if that ever happens, because generally about 99% of the time, this never happens. The Federal Reserve, the FDIC just take them over and ship them off to somebody else. And again, every single bank in this country, every bank that does retail business is FDIC insured. Okay, now the Federal Reserve. The Federal Reserve System, founded in 1913, it's the Federal Reserve Bank. Prior to 1913, we did not have a central bank. So the system as we see it today was started in 1913. And it oversees the banking system, is responsible for the amount of money and credit in the economy. The Federal Reserve is an independent agency. The Federal Reserve is not part of the government. It is not a government agency. The Federal Reserve is its own agency. Now, some of the leadership of the Federal Reserve is appointed by the President and confirmed by the Senate for 7 years. And Janet Yellen is the current chairman of the board of the Federal Reserve. And but they're independent. You can't fire them. You cannot fire them. They're appointed, and they're appointed throughout their term. You cannot get rid of them once they're appointed. You know, so they are independent. They do not take orders. What the Federal Reserve has done since 2008 is what the Federal Reserve wanted to do. This is not something that was in any way conducted from the Capitol or the White House. This is something that the Federal Reserve wanted to do on their own. The Federal Reserve is an independent institution, and that's the only way how Federal Reserve or central bank policy works. You need it to be independent, or otherwise governments use central banks as money printing agencies. I need money, let's print some money. And we've seen that like places like Russia, for example. They needed money, so they turned on the presses and started printing money. We need to pay our civil servants. We need to pay our military, but we don't have any money. Well, let's just print some. You know, obviously if you do that, the only thing that you create is disaster, because you're creating inflation. Yes?
This might be slightly off topic, so just tell me if it is. I have friends that are really into somewhat conspiracy about how the Federal Reserve started and the cloud of mystery that kind of got started, and also built upon, we had a gold standard at one time, and how this is removing us from that standard. And there's somewhat both in the same camp of this individual, you know, let's not have the government control question is, how big of a role would that play in an everyday individual like us?
There is no reason for a gold standard. The reason why the gold standard was abandoned, and it was abandoned in 1972 because, you know, the US was basically losing their gold reserves because everybody around the world was taking dollars and exchanging it for gold, you know, and it was not something that was sustainable. The gold standard was created after World War II because there was only one economy left standing. And in order to create international trade, that's what it's for. And I'm going to talk about a lot more about this in our January session, because the gold standard is about international currencies. It is not about a domestic currency. A domestic payment system is not really determined by the gold standard. It is about why am I willing to accept euro from you? You know, the only reason why I do that is because I think I can exchange it for dollars. But why am I able to do that? What creates that value? You know, the dollar, money in itself in a domestic setting has value because somebody else is willing to give you something in exchange for it. You know, and that is regardless of a gold standard. This is because somebody's willing, there is a value established in the, and an understanding in the economy that money eases transactions. You know, it's a lot easier than barter trading. Now, if you were to go to the grocery store and get a gallon of milk, and you would have to, you know, trade it for a pair of shoes, you know, that would make it a little cumbersome, the whole shopping experience. You know, but if you have money, somebody's willing to accept your money. That's why, for example, when back in the 90s, you know, the US dollar was always the easiest currency to forge. Still is, you know, because it's all the same size, all the same color, and but that's why they made all these new banknotes, so you cannot forge them anymore. But for the longest, they were really easy to forge, particularly when color copiers came along. You know, it was really easy to do that. That's why there was a time when people were very reluctant to accept any bill larger than $20. You know, there are times when you would go into a store and they said, we don't accept any bills larger than 20. Because they were afraid that they were getting some fake money. Now, what that effectively means to you, if you walk into a store and you have a $50 bill on you, that $50 bill has no value whatsoever at this point in time, because they are not going to accept it. Unless you buy $50 worth of stuff, and even then they might not have accepted it. You know, they said, no, I'm just not taking it. So that $50, you could have as well walked in the store with no money. You know, even though, look, it's $50, they said, you know, God, we trust the United States government and everything on there. I said, we don't care, we don't trust it. And therefore, we don't take it. At that point, it becomes printed paper, that's all it is. So what makes, and if you had gone in there with an ounce of gold, they might not have taken that one either. You know, because of that, what am I going to do with this? You know? So that's why we have money, it makes this easier. Now, the gold standard is purely for international trade. We needed to create, after World War II, a system that allowed exchange rates, that we could trust in that. So if I were to exchange my Swiss franc for dollars, or if you gave me a Swiss franc, I needed to be sure that I could get those into dollars, and then if I didn't like the dollars, I could get gold for them. That's what the gold standard was for. It was not for domestic payment systems. So all of these things, you don't have to worry as an individual. You don't have to worry about the value of the dollar. You know, one of the things that the Federal Reserve does, and what they've done very well, is keeping inflation down. That's one of the main things. We'll get to that in a minute. I hope that answers your question.
Can I ask just a question?
Yeah.
I understand how, you know, it's your standards based on your economy and all that, but doesn't going off the gold standard also allow the government to print a lot more money than it normally would be able to on the gold standard?
Well,
like we can just flip
well,
the sheet, and we do print.
What happened is that actually started running deficits in the 60s, and as a result, what it did, yes, it made it easier for the government to take on more debt. That is absolutely correct. You know, because there was a shrinking confidence in the dollar in the 60s and early 70s, and that's why people would take their dollars. All the foreign reserves, all the countries that had dollar reserves, they would take their dollars and wanted them gold for them. And the US just they lost a third of their gold reserves in 1972. 1/3 of the gold reserves of the US were gone because people were exchanging their money back into. That is correct. It did allow countries to take on more debt. The problem is that we had a gold standard in place that said the US backs all the gold, backs all the currencies. It did not prevent any other country in the world from taking on debt and then coming back to the US and basically have to pay for it. So that was a flaw. The gold standard in itself was not sustainable for the US as an economy. It was not a sustainable thing to do. Now, was one of the side effects that it's easier for the government to raise debt? Absolutely. You're absolutely right. But it would not have been sustainable. It would have actually done much more harm than good if we had held up to the gold standard when it was abolished in 1970. So money supply and credit to the economy, maintain stable prices and full employment. When you hear about what the Federal Reserve says every month, it's about we have a certain goal of what unemployment is going to be. We have a certain goal of what the rate of inflation is supposed to be. If we don't meet that goal, we are not going to raise interest rates. That's what they say. That's what they're trying to do. It needs to be a certain level of inflation. Right now, it's actually too low. It's not too high. Generally, they want to bring it down, but right now, they actually want to bring it up. There's got to be, and they also make sure that the payment system works fine. The payment system got to work. There are backing the payment system. Your checks are being cleared by the Federal Reserve, and you write a check. The Federal Reserve clears those. When money needs to replace, it's going to go through the Federal Reserve. So they make sure that everything works in the background. You never see them in the foreground, but you see them in the background. This is just, and I put this in there so for you to look at. This too, just to give you the 12 districts. We're in the 6th district, that's Atlanta. This is where the headquarters are. We do have a Federal Reserve on Liberty Parkway right here in Birmingham. If you've seen it, there's not much happening there anymore. There's about 20 people in there, if that many. It used to be a major check clearing operation here in Birmingham, but all checks are being cleared electronically these days. There's only one check clearing place in the entire country left where they're actually being cleared manually, and that's for checks that are altered. If you write a check and then you alter something on the check, they're not allowed to clear it electronically. Then it actually needs to be cleared manually, and it takes a little longer for the check to clear. But otherwise, all checks are being cleared electronically. But Birmingham is one of the backup offices for the Federal Reserve. So in other words, if the US were to be under attack or there were a terrorist attack, Birmingham is one of those backup stations because I guess people figured there's never going to be a terrorist attack in Birmingham. So that's why they're created as in Birmingham. Birmingham is one of those backup stations. Stable prices, maximum employment, as I said, these are the two goals. The Federal Reserve wants 5% unemployment, and they want at least 2% rate of inflation. That's what they want to see. If they don't have it, they're going to do something to change that. Moderate long-term interest rates. Right now, we have obviously our interest rates close to zero. That's because of where we are in the economy. And I get to that in a minute. These are the monetary policy tools. Federal funds rate, interbank overnight interest rate. The Federal Reserve controls the federal funds rate. They don't set it, but through open market operations, they buy and sell securities in a way that they bring it to the point where they want it to be. It's not a rate where the Federal Reserve said federal funds rate is 0%. It's a goal. It's a target. And they do open market operations. I want to go into the technicalities of that, and then leave it and keep it down that way. Discount rate, lender of last resort. You can go as a bank. You can go to the Federal Reserve, and you can borrow from them. You can get money from the Federal Reserve. And that's what the discount rate. Now that one is set. They said you're going to get. Now these are collateralized loans, meaning the Federal Reserve doesn't just give loans away. You're going to have to actually pledge securities against those loans. If you don't have any securities to pledge, you're not going to get a loan. So there are secured loans. They're not unsecured loans. They don't just give money. Reserve requirements. I already talked about those previously. Finally, we heard a lot about quantitative easing. Now, government securities or other securities are purchased by the Federal Reserve in order to lower interest rates and increase the money supply. That's what quantitative easing is. Now, generally, the way you would do that is by lowering interest rates. You know, you bring the Fed funds rate down, you bring the discount rate down. When you've already brought those down to a point where you can't bring them down any lower, then you have to go into quantitative easing. That's when the Federal Reserve stepped in the market and started buying treasury securities and particularly buying mortgage-backed securities from Fannie and Freddie. That's what they did. So then they don't do that anymore. They stopped the quantitative easing last October 2014. They've not done that anymore. But during the time that they started doing that, and again, this is not printing new banknotes. There's no money being printed. What the Federal Reserve does, they're going to buy these assets from generally banks, and then they're going to credit their accounts with funds. That's what the Federal Reserve does in exchange. There's no new money being printed. That's an exchange of assets. That's all it is. When these assets mature, so in other words, when those Fannie Mae or Freddie Mac securities, if they mature, then the Federal Reserve is just going to take that money out. You know, it's just the money that they get back at maturity, the payments that are made to the Federal Reserve in return to the investment in those securities, that money is not going to be circulated back in the economy. It's just going to stay out. You know, that way you don't increase the money supply to a point where you create inflation, because we have not seen any inflation being created by this. And we have increased, the Federal Reserve has increased their balance sheet from $1 trillion to $4.5 trillion as of this October, or last October, 2015. So 4.5 times. That's how much they bought $3.5 trillion worth of securities to get the economy back on track. The idea was to provide the banks with funds that in turn they would lend out to businesses and individuals to get the economy back on track. That was the idea of quantitative easing. Now, right now, the Federal Reserve does not add to this anymore, but the Federal Reserve is not ready yet to lower the asset holdings. Meaning, if what I just said, when an asset becomes due, they're not going to replace it. Right now, they're still replacing them. They're just not adding on to it because they don't think that the economy is ready for that yet, for that liquidity to actually be taken back out. So they are still replacing them, but they're not adding onto it anymore. That's when the quantitative easing stops. We're not adding onto it anymore, but we're not scaling it back. Eventually, the Federal Reserve is going to scale this back. How far remains to be seen, but they are going to scale this back, and they're going to take some of that money back out, because once the economy really takes off, they need to take that money out, or they're going to create inflation. And that's not something that the Federal Reserve wants, and has a very good track record of avoiding. We never had a problem with inflation in this country. The largest we ever got to was in the late 70s, 79, 80, when we, I think, got to like 8 or 9% of rate of inflation. That was about the highest that we had, and that's compared to the rest of the world, this is really nothing, and so they have a very good track record on keeping inflation down, which is their #1 goal. Inflation and employment, those are their two #1 goals, and all their monetary policy is based on that, based on what we can do to keep inflation at a certain range and keep unemployment down. Okay, any questions? Yes, sir.
How does quantitative easing, like Germany and other countries, differ?
It's not. It's not different. The only difference is that it's a central bank that buys securities from all kinds of different governments, and not just one, because the euro. They're mostly buying the German securities because they're considered still discrete. So they're not going out, and the quantitative easing, for example, Greek securities are not included into that purchase program. They're not allowed to buy those. But they're just buying securities from an array of countries, from member countries. But other than that, the exact same logic behind it.
Are there any differences between the internet banks and those that have a physical presence?
Other than they're all regulated the same way, they're all FDIC insured. The only difference is that you cannot physically walk into a building. Yes, sir.
Earlier this week, there was a new federal banking regulation that suddenly got put into effect, and it caused a number of banks to have their bonds downgraded. What was that about?
That is a good question. I can't answer. I would have to look up on that. I don't know. I don't know what happened. You know, all I can think of, it might probably something to do with asset quality. You know, where the Federal Reserve increased their standards of asset quality, and there's some regulation going in effect gradually about liquidity reserves that banks have to hold. That's one of the things that they never had to do before. But when we found out in 2008 we had a liquidity problem, banks did not hold enough liquidity. They're now required by law to hold more liquidity, and it could very well be that some of these banks did not meet those standards. Yes, sir.
I'm probably going to use the wrong terminology, but there's a bank locally that was attempting to sell to us a kind of what they called equity investment, which was being sponsored by Goldman Sachs in the form of a sort of CD. And they claimed that one of the virtues of this purchase is that since Goldman Sachs was now a bank, this particular purchase was insured by the Federal Deposit Insurance Corporation. So that in addition to the money one had in the local bank, one would also, by proxy, have a purchase of this particular CD with Goldman Sachs. Now, did what I just say make any sense? And I think you answered part of my question, which is, since when is Goldman Sachs a bank?
There are now.
And then I noticed, too, that insurance companies now are starting to function as banks.
Yes. Yes.
So there are really two questions here. Number one, is what I just described coherent? And number two, is the increasing persona of bankishness something that has a downside, and is it something that one ought to be leery about, or is it yet to be seen exactly how that's going to affect the economy?
Well, to answer your first question, the only way that Goldman Sachs would also back up your deposit is if there is a guarantee written by Goldman Sachs that if something happens here, we are backing up this claim. So, you know, so we're backing up this claim. Then you would get the protection from Goldman Sachs. As far as the second question is concerned, you can apply for a bank charter. Anyone can apply for a bank charter. You personally can apply for a bank charter if you want to. You know, it's a matter of how much money you are willing to put up and some other qualifications. But what we see is that generally when the banks get a bank charter, then, you know, they are fall under these regulations. And then they're also FDIC insured. So in terms of your money in the bank, your money is safe. Now, that also puts them into under supervision. Now, obviously, if we see a major increase in banks being created, that puts strain on the regulators and the bank examiners. And one of the things that we've seen in recent years is a hiring spree by regulators in terms of getting the number of bank examiners up. Because that was one of the problems that we had prior to 2008, that there were not enough personnel actually looking at these banks. You know, so as long as the regulators keep up with the number of banks and hopefully applying only giving charters based on what they can handle, then there's no problem. But if they're obviously are falling short on actually monitoring the banks, then we might see problems.
Earlier you mentioned about the FDIC insuring $250,000 per person per account, and you gave the example of a CD.
Yeah.
An account that I've been trying to understand recently is a money market account.
Yeah.
And what I kind of get confused on with that is, to my understanding, a money market is when the bank takes your investment and then invests that in stocks and bonds and such. So does that then count, is your money then insured as an account, or is it then fall under stocks and bonds?
That is a very good question, and that depends on how the bank sets it up.
Okay,
Now, generally, money market account, they take your money and invest it in money market securities, which are all short-term bonds generally. If they set it up as a kind of like a mutual fund kind of deals, it is not FDIC insured. You know, then it's SIPC insured. So there's an insurance for securities accounts as well.
what was that acronym?
SIPC.
SIPC.
Securities Investors Protection Corporation is the name. They're up to $500,000. The process of getting the money back from them is significantly more complicated than the FDIC. If they set it up as an account, and they're just telling you your interest rate is based on some sort of index or something, money market index. It's okay, based on that index, that's the interest you get. Then it's still an account and it's still FDIC insured. So they will tell you. They will tell you which one it is.
So like if they offer, bring in X amount of new money and you get this, 1.35% or something on money market account, that is FDIC insured.
I just asked them, make sure that it is an account where I said, okay, we're just adjusting the interest rate based on this index or something like that. And ask them if it's FDIC insured. It depends on the way they set it up. But generally, banks are going to set it up that way that it's FDIC insured. If you get a money market account to be brokered firm, it's generally not FDIC insured. So because they set it up.
Okay.
Yes.
What's the official policy for the federal government in Bitcoins? If I wanted to invest in Bitcoins and there's a bank that lends money, but not in anything else but Bitcoins, digital currency, and that.
Yeah, I'm not a big fan of these Bitcoins because there's a lot of things going on, a lot of extortion going on, and I think it's one of those gray areas that really has not been it's between the Bitcoins and the payday lenders. Those are two areas of the financial market that have not been addressed yet by the government with regulation. So I personally would stay far away from these things. Yes. Yes, of course.
Brothers and sisters, please stand and face our American flag. This is our last one. And veterans, and salute. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, liberty, justice for all. Two. Swante move.
Any other questions?
Dodd-Frank, good, bad, or indifferent?
Can you add Glass-Steagall and how deregulation has kind of
Okay, sure. Well, there are, Dodd-Frank in generally is a good idea. It has not been implemented even half of what they all want to implement. There's a whole lot of things on paper, a lot of it has never been actually implemented yet. Certain things like the Volcker rule are a great idea. That is, it restricts proprietary trading by banks because that's what got banks into trouble in the first place. Basically, and to talk about Glass-Steagall, as I said, Glass-Steagall, there was a law that separated commercial banking and investment banking. And banks could not do both. They could only do one or the other. Now, the reason why Glass-Steagall was put in place was not because somebody was afraid that banks were getting too big, but because banks would tell their customers, well, if you issue stock, we're going to help you issue stock, and then with the proceeds of that stock, we're going to pay back the loans that you have with us. And that was a problem. And that's why Glass-Steagall was being implemented. That's why that was implemented when it was implemented, because banks were afraid that businesses would go under, so they just said, hey, you issue equity, and then you pay us back with those proceeds. And that was obviously not good for the shareholders.
Yeah, I couldn't remember the other part, the regulation, deregulation part in the 90s and early 2000s. Dodd-Frank was one thing I was curious about.
In '98, Glass-Steagall was repealed. There was a law that repealed Glass-Steagall. We do allow to have universal banks. My personal opinion, and that's just my opinion, is it's not about not necessarily a problem of how big the bank is, but what you allow them to do. That's where it really comes down to. But Glass-Steagall was repealed. Dodd-Frank brought on a lot of good things. As always, you know, when we regulate, we always shoot a little bit beyond what we needed. You know, that's going to happen, and some of it's going to be scaled back. But you know, it's certain things when you look at Dodd-Frank and some of the things that had to be put in there. Like, for example, there's a phrase in Dodd-Frank that requires banks to prove that whenever they make a mortgage loan, that the people that they give a loan to actually have the funds to pay it back. And it's amazing that you actually have to put that in a piece of legislation to make sure that they do that. But if they hadn't done that, if they had actually always done that, that wouldn't be in the legislation. So anyone who complains about it can only be the ones that didn't do it. Because if I already done it, then the legislation doesn't change anything. You know, it doesn't change anything in how we do
It's
business.
almost like a loophole.
Yes, yes. Well, I mean, it's like there were certain things that they were allowed to do that were not specifically regulated, and they got away with it. And that's what Dodd-Frank was trying to do. And for more consumer protection. That was really what the main thing about Dodd-Frank is about. It's about consumer protection and protection of the financial system to make sure that we can rein in some of these risk-taking. You know, again, it's not so much about the size, it's about the risk-taking. You know, taking these enormous risks with the investments that then put other people's money in jeopardy. And that's what Dodd-Frank was trying to regulate. That's the main thing. And because Dodd-Frank, I showed you this list, Dodd-Frank, you got to be a bank with 10 billion plus in assets to be even regulated by Dodd-Frank. If you're a small community bank, you're not regulated by Dodd-Frank. This is regulation for large banks. This is not regulation for small financial institutions. It's to make sure that they don't do things that they're not supposed to do. Thank you, guys. Any other questions?
Is there any hope of seeing a rise in interest rates anytime on the horizon?
Well, you know, you never know. Janet Yellen said today
That's it.
that there's a good reason, a good chance that it's going to happen.
She
You
said
know,
that a few months ago.
yeah, I know, and they keep saying it. And I think they keep saying it so people are going to continue to believe it. And it's going to happen eventually. Do I believe that it's going to happen in December? No, I don't believe that because we still see too much variation. Now, I think one of the things that sparked her to say that is the fact that we finally have a budget in place until 2017 at least, you know, which takes the uncertainty out of the debt limit and all of that, debt ceiling and all of that. That helps. That helps the economy. That might actually spark the Federal Reserve to raise interest rates. But I don't see it happening. It's an election year too. And, you know, in history, the Federal Reserve has never done a lot of things to an election because they don't want to make themselves a focal point.
They don't want to make themselves a target.
Yeah.
It's talking points of both parties.
They don't want to be seen as being on one side or the other. And that's why in election years in the past, the Federal Reserve has not done much. So based on that, I wouldn't expect much, not before the presidential election of next year. Which I know is not good for a lot of people that want to make money, but and this is just, you know, that's probably that's what I would expect anyway. Yes, ma'am.
This is, I think the FDIC, this is how I understood it, that you've got 250 insurance as part of a joint account owner, and 250 as a single one owner. Even as part, you said it, you got 250 for checking and 250 for money market, but if you're a single owner on those accounts, they combine those two things to make the 250. Or you can be part of a joint ownership for a 250.
Yeah, but it is per account type. So yes, a checking account, one person, 250,000. If you have two checking accounts, and some people have multiple checking accounts, each one, and all of them together are just 250,000. But if you have a different account type, then
It's type, not
yeah, if it's a different type, it's another $250,000.
like a CD type or
Yes,
checking.
yes. If you have a CD, that CD is separate from the checking.
They don't pull
No.
from
They
the
don't.
types.
Yes.
Okay.
And again, if you want to be sure about it, you can go to their website, fdic.gov, and they actually have a calculator where you can put all that information in, and they will tell you exactly how much of your money is insured. Yes.
Thank you very much.
Thank you.
Well, thank you.